We have seen in detail in the previous videos. However, just to revise the effect, when the central bank sets the interest rates, the market interest rate high, the inflation will drop, people tend to save and do not borrow. This will result in accumulated cash in the financial system. Also, this will decrease the demand, which lowers the inflation, but this will decrease the job opportunities or employment, because if the demand is lower, this means individuals doesn't have enough money to hire employees, because the money supply in the market is minimized due to the higher interest. For more, you can click here, or the link is in the description, that talks about the interest rate effect, the inflation and employment in detail. Other monetary policy that is applied by the central bank is to control the bank reserve requirement. There is something called the reserve ratio. So the central bank might apply a contractual or expansionary monetary policy. Contractual is, as the name indicates, to contract or to reduce the money in the market to the financial system. Expansionary means to inject the money in the market or individual's hand rather than in the financial system. As we know, lowering the interest rates, the market rates, makes the people to borrow, which is one of expansionary monetary policy, setting the interest rate low. However, setting the interest rate, the market interest rate high, is a contractual monetary policy, because people will deposit their money and they do not afford the interest payment if they want to borrow. This will elevate the money in the financial system high more and the money in individuals' hands less. In other words, the money will be pulled out or contracted to the financial system rather than individual hands. This is how interest rate affects the inflation and employment opportunities. However, when you talk about a reserve, there is something called a reserve. There is something called a reserve. Reserve means what individual banks pays to the central bank. Every bank puts their reserve money into their central bank's account 2 times. One is when they are formed. So this will happen 2 times. One is when they are established from their working capital or from their capital. For example, let's assume on the year 1, this bank has established and prepares $100 to work or to start its business. However, the central bank will take some amount of money from this $100 or the beginning balance of this bank. The amount this Federal Reserve Bank took from the beginning balance is called reserve, and this reserve is stated in terms of some amount of percentage. For example, if it is 10%, this means the bank will pay $10 to this reserve or central bank, and it can operate using this $90 for its operation, leaving $10 in the reserve bank. Let's say this happens on the year 1. So if the reserve requirement is 10%, all of the banks will pay 10% of their beginning balance. For example, if this bank has $200, he will pay 10% of it. That means $20 will be deposited in the central bank, and $180 of it will remain for its operation as a beginning balance to work on it. So from their capitals, all of the banks should put some amount of reserve to the central bank, 10% on the year 1. However, when they reach year 2, they might have some amount of profit. Also from that profit, they should deposit some amount of reserve to the central bank, the amount that is stated in the reserve requirement ratio. For example, if this bank has a profit of $100, this means he has $90 at the beginning and had a profit of $100 at the end. From this $100, which is the profit, the central bank reserve requirement, let me take it as 10%. This means also from the profits, he can only take a profit of $90, leaving $10 for the reserve bank. In total, the bank has reserved in his account, which is on his account $20 at the end. Also, other accounts of banks might be affected depending on their profit and loss at the end. So as an example, we took 10% here as a reserve requirement ratio. What if this 10% increases to 50%? Is it possible for this to bring an impact on inflation and